All right, in this lesson, we're going to show you the 5 steps to solving a transaction. Now, before we start with the 5 steps, I want you to know that there is one step that we're not going to learn in this lesson. And the reason why is we've got another video that's dedicated to learning the steps to that and what you need to know about that. So we're going to go really over 4 steps to solving a transaction. We'll skip one step, but we've got a whole other lesson that is dedicated to understanding it, and what it really comes down to this idea of debits, credits, and how they affect the accounting equation. But for now, we're going to give you a baseline, fundamental foundation knowledge of solving an equation, and once you have that, then we can build onto that, this idea of debits and credits, and then solving it for the accounting equation. So let's start off with the transactions. So step number 1 is we're going to figure out, is this a transaction or not? Now, it might be simple to think, well, isn't everything a transaction? But in reality, what we're saying is, whatever the company is doing, is it a transaction that affects the financial statement? So for instance, let's say they hire a new employee. Well, the mere hiring of a new employee doesn't necessarily warrant a transaction in the accounting system, okay? When do we trigger something into the accounting system? Well, we trigger something into the accounting system when we pay them. That is a transaction. But the mere hiring of an employee, not a transaction. Or even just a mere handshake agreement with another vendor saying that they would supply us is not a transaction. What is a transaction? When we start to buy things from that supplier, then we're going to have transactions. Okay? So step number 1 is going to figure out, is it a transaction? Now, in accounting, typically we don't oftentimes trick anybody. So there isn't a lot of times when you're going to see something that it's not a transaction. But there are times when something will be given to you and it's not a transaction, it's like a footnote or something to know. But something else has to happen before the transaction actually happens. Okay? Then step number 2 is we're going to identify which components of the accounting equation does the transaction affect. Okay? Now, we're putting this here to help you understand it. Once you understand it, these 5 steps will go through your head very quickly. So we're going to first figure out, okay, in this transaction, what components is it going to affect? Well, the components we just learned were assets, dividends, expense, liabilities, owner's equity, revenue. So which components does it affect? Now, we talked about this before. Every transaction has an equal and opposite other transaction. So you will always have 2 components. Now here's a trick. Those 2 components can be the same components. They're not necessarily different components, but you must have 2 components. Step number 3 is we're going to identify the account and whether it's increasing or decreasing. So we're going to identify the account based on the component. So if we know the component's an asset, we know that it probably is going to either be cash, equipment, AR, supplies, inventory. We know that if it's an asset, it's not going to be utilities expense. Okay? We know that it has to be an account within an asset category or an asset component. Okay? So identify the account and then whether or not it's increasing or decreasing. That one's a little bit tricky. I added that here on this lesson, but we're going to do more of that as we go through, and then you'll see where it makes sense. Step number 4, we're going to look at later on, so we're going to skip step number 4, and step number 5, we're going to book the transaction into our books. So for today's purposes, we're going to book them into the books, but it's not necessarily the proper way to book in the books. We just want you to get an idea of how we book into the books, and then we'll show you the proper way when we talk about actual journal entries in a later lesson. So to get us started, we're going to start with this example right here. Assume that we want to start a company. We take $5,000 in cash and put it into the company for equity into the business. So the first question is that a transaction? Well, we are giving the company $5,000, which means it is a transaction because the company is getting some type of asset at the end of the day. Now, when we do this, we have to think of this as the company. We're not the owner, okay? We're not thinking of this as the owner. When we're thinking about the transaction, we're the company. So what's happening with the company? Well, what components? What am I getting? Well, I'm getting $5,000 in cash. We know that cash is an asset. So we know that from a component standpoint, we're going to deal with an asset, okay? Now, what about equity, okay? We're going to give up equity. How did we get that cash? Well, we got that cash because we gave up equity as a company, okay? Which also means what? Well, we know from previous lessons that It's not an asset. We're not giving up an asset. We're not giving a dividend because that would be a withdrawal. Well, we're not giving the owner money. It's not an expense because we're not incurring an expense. It's not a liability. We don't owe anybody anything. Remember, if you invest money into a company, you don't expect it back. So it's not a liability. Owner's equity or owner's investment. Owner's investment. They're investing money into the business, therefore we're giving them owner's investment. So then this other component is going to be owner's investment or owner's equity. Again, like I said, I usually teach as owner's equity. It really should be called owner's investment, but I always get them confused, so I always use owner's equity. Okay? And it's definitely not revenues because we didn't earn it. It wasn't given to us as part of the earning process, therefore it can't be revenues. So the two components that we're going to work with are assets and owner's equity. Now what accounts? Again, you're going to learn the accounts as you go, and sometimes they're made up. So it's not like there is a rule book, but oftentimes you're giving something called a trial balance, and that's all the accounts that a company uses. So you got to find one of them that it fits to. So account. Well, we know we're receiving cash, so the cash is an asset, so we know we're going to hit the cash. Okay? Now, for owner's equity over here, we're going to use something new that we talked about in a previous lesson. We're going to use capital stock. Now, we can call this common stock if we wanted to. Okay? Either one is okay. Capital stock or common stock. So now that we have an account, well, if we're the business, is it increasing or decreasing each one of these accounts? Now, we got to be very careful here. Cash is easy. Well, if I'm the company, I'm receiving cash, that means cash increases, right? Okay? But what about owner's equity? Now, there's two ways to solve it. The first way to solve it, we can look at the equation. Well, if asset goes up, where's owner's investment? Owner's investment's over here. Owner's equity's over here, which means this has to go up. There is no choice then to go up, okay? You can't go down. It's not like we have less equity. We do, but we don't have less equity. It has to go up, so this increases as well. Now, before I leave off the topic of why it increases, think about this. In accounting, the dividends, expense, and sometimes owner's equity, and the revenue are what we like to call scorecards, okay? Think about a sport. If we make a touchdown, what happens to that scorecard? It goes up, okay? So those four accounts or four components are scorecards. They keep score for us, okay? So because they keep score for us, we increase them when more activity happens, okay? So when we pay more dividends, we increase it, okay? If we take dividends back, which never usually happens, but if we take dividends back, then we decrease it. So normally, dividends, we increase. Expenses, it might not sound right, but when we incur expenses, we're trying to keep score of how much expenses we are using, therefore we're increasing expense. We're always increasing expense. On the owner's equity, when we give out more equity, we want to keep track of that equity, so we increase it. That's why that is here, okay? And then revenues, again, as we make more revenues, we want to keep score. We really want to keep score of revenues. Maybe not in expense, but we want to keep score of revenues. And because we want to keep score, every time we make a sale, we want to increase revenues. Therefore, we increase revenues, okay? So think of revenues, owner's equity, expense, and dividends as scorecards, not necessarily up or down, okay? So how do we book it? So identify the accounts. We've identified the accounts. We've identified them as increasing or decreasing. Now we need to book them into the transaction, or book the transaction. We're going to skip 4 because 4 has to do with another lesson. We'll go back to that in that lesson. But so we're going to book the transaction. How do we book it? Well, what happened with cash? Cash is an asset, so we're going to put cash here. Okay. And what happened? Well, it increased by $5,000. So we're going to put plus $5,000. Okay. What about owner's equity? Well, that also went up, so we're going to go common stock plus 5,000. Okay. Now, let's give you another transaction that's not on the board. Okay. Let's assume that we decided to take $2,500 of cash to buy supplies in order to do some testing. So we can do all of this by asking what is happening here. Well, let's take a little bit time here to erase this. So what's happening? We're going to take $2,500 of cash okay? And we are going to buy supplies. Now, supplies, again, meets the definition of an asset, right? Supplies are things that the company owns to yield a future benefit, okay? So if that's the case, we know that we're going to deal with an asset, and what are we giving up? We're giving up cash, which is also an asset. Notice I'm using asset and asset. I'm not using dividends, expenses, liabilities, owner's equity, or revenue. Okay? What about accounts? Well, we said cash. And what are we receiving? Supplies. What's happening here with the increase and decreasing? Well, cash decreases, obviously. Supplies, we're getting supplies, so that's increasing. Okay? So how do we book the transaction on 5? Well, we're going to subtract 2,500 here. That gets us 2,500. Now, I don't have a lot of space here, but right next to it, I'm going to write supplies because it's an asset, plus 2,500. So that gets us 2,500. Now, does the equation still balance? Well, let's take a look. 25 plus 25 plus 0 equals 0 plus 5,000 plus 0. Well, 5,000 and 5,000, we balance. Okay? So in this lesson, we kind of took you through this idea of booking a transaction and the steps that go into the transaction. Step number 1 is we got to figure out whether or not it's a transaction. Step number 2 is we're going to look at the components, what component it is. Step number 3, we're going to look at what accounts we're going to hit. And we're also going to look at if we're going up or down. Step number 4, we're going to talk about in another lesson. And step number 5, we're going to book that transaction into the accounting equation. Okay? So again, this will give you a brief understanding of the accounting equation and how we book a transaction. In a future lesson, not the next lesson, but in a future lesson, we're going to look at how step number 4 plays into all of this. Okay? So hopefully you kind of have an understanding and a base understanding. If you don't get this, my suggestion is go back to the beginning of this lesson, review it again, so that you really understand that. And then once you understand that, progress to the next lesson. That will help you understand how we make journal entries.